watching the latest news from financialmirror.tv. World stocks put in strong gains on Monday as investors took comfort in global efforts to prop up the banking system, allowing for some bargain hunting. European shares followed Asia higher, and Wall Street looks set for a positive start. Gold rose after recent losses, the dollar reversed earlier falls, and demand for government bonds fell. Oil rose to $74 a barrel on expectations that OPEC may cut output by 1 million barrels per day to boost prices, even though analysts expect the oil price to fall to $50 a barrel by the end of next year. Interbank lending rates, at the centre of fears about the industry freezing up, fell significantly, suggesting that government efforts to provide support were bearing fruit. ECB President Jean-Claude Trichet added to the confidence building over the weekend, pledging in a radio interview to do whatever it takes to restore confidence to financial markets. He said the ECB was working very closely with the US Federal Reserve to solve the financial crisis that's crippled equity markets for more than a year. French leaders presiding over the 27-nation European Union have called for uniform rules that apply everywhere, including tax havens, even calling for a revamping of capitalism. Also over the weekend, South Korea promised $130 billion in state guarantees and capital injections for banks, while the Dutch government said it would help financial group ING. The Swedish government on Monday said it will provide credit guarantees and a bailout fund of 1.5 trillion Swedish crowns, or $205 billion, as well as 15 billion crowns in a stabilisation fund. European shares rose early on Monday, extending the previous session's sharp gains, with banks gaining on optimism that the financial sector crisis may ease. Banking shares such as UniCredit, Deutsche Bank and Commerzbank advanced, while ING surged 22% after it became the latest European bank to seek government funding, agreeing to a €10 billion cash injection, as well as scrapping executive bonuses and its year-end dividend. Fortis, Lloyds TSB, Royal Bank of Scotland and Barclays gained, but Societe Generale and Dexia dropped. The FTSE Eurofirst index of top European shares was up more than 2%, having gained 4.2% on Friday, but has lost 39% this year. Energy shares added most points to the index as oil stocks gained between 3 and 8%. Germany's cabinet on Monday approved strict conditions for banks that make use of its €500 billion rescue package, including limits on managers' salaries, bonuses and severance. Miners were up as copper and zinc edged higher, while precious metals prices also firmed. Ericsson rose 20% after it posted stronger than expected third-quarter earnings, showing no sign yet of damage from the financial turmoil. China's economic growth slowed to 9% in the third quarter, dragged down by the global credit crisis and a weak property sector, leaving the economy on course for its first year of single-digit expansion since 2002. The fall in annual GDP growth from 10.1% in the second quarter confirmed that China cannot decouple from the struggling world economy and reinforced expectations that the government will soon further ease monetary and fiscal policy. Markets were initially disappointed by the third quarter figure, which was well below economists' forecasts, but the Shanghai stock market recouped early losses to close up 2% on expectations of monetary easing and support for the property sector. However, some analysts warned against jumping to conclusions too quickly. Interpreting the third quarter statistics is tougher than usual because Beijing pulled out all the stops to reduce pollution during the Olympics in August, prompting factory closures as well as transport and visa curbs that hit output. China has accounted for about a quarter of additional global output in recent years, devouring iron ore, oil and other raw materials, and will almost certainly leapfrog Germany this year to become the world's third largest economy. Britain's public sector net cash requirement hit a record high for September, official figures showed on Monday, and the government finances look set to deteriorate even further in the months ahead. The Office for National Statistics said the public sector posted a net cash requirement of £12.6 billion, compared with a deficit of £8.7 billion in the same month last year. Analysts had expected a reading of £10.1 billion. Central government outlays were boosted by some £9 billion because of payments associated with the rescues of Northern Rock and Bradford and Bingley. Meanwhile, mortgage lending fell 10% last month to the lowest level since January 2005, hit by weak demand and the global financial crisis. Banks and building societies loaned £17.7 billion in September, down 42% from the same month last year. Analysts said that weakening consumer demand and ongoing funding restraints will dampen monthly lending figures for the rest of this year and into the first quarter of 2009. With less than 3 weeks to go for the US presidential race, Democrat Barack Obama has widened his national lead over John McCain to 6 percentage points. The latest Reuters C-SPAN Zogby poll released on Monday shows Obama leads McCain 50% to 44 among likely voters, up from Obama's 3-point advantage on Sunday, despite the Republican candidate having gained ground after their final debate on Wednesday. Obama has huge leads among young people, African Americans and Hispanics, according to pollster John Zogby. Also, his edge with independents rose from 8 points to 11, and his lead among women grew from 6 to 8 points. McCain narrowly trails Obama among men and leads by 13 points among whites. The expanding lead for Obama came as he received the endorsement of Republican former Secretary of State Colin Powell and announced he had raised a stunning $150 million in September. His fundraising haul shattered the records he already owns and will fuel a huge advantage for Obama in paid advertising in the final 15 days of the campaign. And thank you for watching FinancialMirror.tv.